Don't be stressed by things like which stock to add to my portfolio ahead of earnings. Today, we're talking about investing simplified, how ETFs and index funds have added tens of thousands of dollars to my portfolio. Starting with an investment that I'm holding in this portfolio that I shared here on this thumbnail that says over 100K. That was back at the end of October of 2025. And today, that portfolio is up by another nearly $10,000. I recently shared an update on some individual stocks that I'm holding in my portfolio, but today, everything I'm sharing was built by not having to choose one individual stock. In order to get started investing, you don't need to know how to pick 20 or 30 different stocks. You can build wealth with this simple strategy that I'm going to show you today. One of the best feelings is going to your portfolio and seeing everything in the green across the board. Not because I'm lucky, but because I've been putting in the work, buying and holding strong, low-cost ETFs and mutual funds that give me exposure to all of those top names, the largest companies in the US, like NVIDIA, Apple, Google, Microsoft, Broadcom, Meta, and so many others. I own them through one diversified system that rebalances for me, kicking out those losers, keeping me on track so that I don't have to figure out every company that's going to be a winner. Okay, first up, let's take a look at these two mutual funds. FLCPX is a Fidelity US large cap fund, and it is 50% of that portfolio that hit 100K back in October. I have a total gain when it comes to this investment of 12.02%. I'm up about $5,900. It has an expense ratio of 0.018%. This site rounds it up to 0.02. So the fees are basically free for holding this fund. And I wanted to highlight this one because this one is linked to my 401k. People need to pay attention. You don't need to just stick with that target date fund. Sometimes there's choices like this. You may not see a VOO or FXAIX in your employer plan, but you don't have to panic. You can look for words like this, large cap index funds. This might help you to find a hidden gem in your company's plan that gives you exposure to all those mega cap companies while taking advantage of your company's match and being a part of the plan. So we don't need to chase individual stocks. We don't need to find the next NVIDIA. Funds like these are going to give you exposure to it. This fund is very similar to another one that I hold in my portfolio, which I often give updates on, which is FXAIX, and that tracks the S&P 500. It's a Fidelity fund that has an expense ratio of 0.015%. And taking a look at these two funds over the last 10 years, the performance is nearly identical. Let's talk about two ETFs doing the same type of heavy lifting, giving me that steady growth, compounding like those first two funds we looked at. This is VOO, the Vanguard S&P 500 ETF, and VTI, the Vanguard Total Stock Market ETF. I always like to highlight, you can just choose one of these two because there is an 88% overlap when it comes to these two funds and nearly identical long-term performance. But these are foundational investments when it comes to the portfolios that I manage. And in this account that I'm sharing today, VOO is up 78.68% and VTI is up 75.66%. These funds are quietly building wealth year after year, quarter after quarter. I'm reinvesting those dividends, not stressing about beating the market. I own the entire market without any stress of always staying on top of the technicals, the fundamentals, what new individual stock I need to add to my portfolio. I have all of the companies traded in the US here, and I'm seeing strong gains. Before we go on to the next portfolio, I'm pretty sure I forgot to share my FXAIX position when we were talking about it at the beginning. When it comes to my largest position, I'm currently up 61.77%, a gain of nearly $74,000 from the 751 shares that I'm currently holding. Now on to the growth layer, we have FSPGX, which is the Fidelity Large Cap Growth Index Fund, SPMO, which is Invesco's S&P 500 Momentum ETF, and SMH, which is the VTI Semiconductor ETF. And here's a look at my current gains. FSPGX, I'm up about 8%, SPMO, 22%, and SMH, 21%. And there are a few shares of FXAIX in this portfolio also, which I'm up about 20% on. This large cap growth fund gives me more concentrated growth exposure. SPMO tracks the momentum, the strongest performers, rebalances for me twice a year automatically. And then SMH gives me exposure to the entire semiconductor industry. And when it comes to these three funds, they are all most heavily weighted into NVIDIA. But I'm not worried about a concentration into companies like these. I see it as a benefit. These funds are going to adjust. And if NVIDIA ever stops being the leader, the funds will automatically move it down and move up the next winner. Maybe Google. I don't have to do the work. The funds do it for me. You don't have to be super risky when it comes to building your portfolio. Many people trying to get rich quick lose money that way. I'm on track to keep on building and compounding over the long term when it comes to the funds that I'm sharing today. And the last one we're going to touch on is SCHD. Now, I've been much more focused on building up those growth positions when it comes to my portfolio, but I do have 58.1 shares of SCHD that I'm currently up 21.81% on. This is a look at SCHD year to date. It's up 15.79%. This one is built for income, but it's currently been thriving year to date due to it being heavily weighted into energy at the beginning of the year. Its portfolio gave exposure to oil and gas stocks like Chevron. Because of the war and the tensions that we've been facing, there was a shift into value funds like this. And it also got a boost from the reconstitution back in March, bringing in new companies like United and Qualcomm. So this fund, the Schwab US Dividend Equity ETF, has 103 holdings. It's most heavily weighted into staples and healthcare before coming down to technology, unlike the other funds that we've taken a look at. One that I'll put more focus on down the road when I'm ready to preserve my portfolio and rely on it for income and less volatility. So some of the lessons that I've learned on this journey to build wealth are that time matters, consistency matters, low-cost funds can have you on track to building wealth. And of course, like I said from the beginning, you don't have to choose individual stocks in order to have quality when it comes to your investing strategy. So don't overcomplicate your portfolio. It's okay to own funds. You're getting exposure to those industry leaders. Buy and hold and let these funds do the heavy lifting over the long term. I do a bit of it all, trading individual stocks, but I definitely rely on these funds for simplicity while having exposure to the companies I want in my portfolio. For example, I added SMH after building positions into NVIDIA, Taiwan Semi, and AMD. So for now, going forward, I'm not going to do another individual stock. I'm going to rely on SMH for my semiconductor exposure. So I hope you enjoyed this update. Make sure to leave me some comments. Let me know. Do you invest into ETFs and index funds, or are you strictly individual stocks? When it comes to your portfolio, what's your best performing funds right now? Hit the like, subscribe, check out my referral links down in the description. Hype this video. And remember, investing is for all of us. Just take some time to figure out the right system that works for you. Comb through those 401k choices and make sure you're on track for the best returns, the best performance possible. Thanks for watching. Okay, bye.